On the afternoon of Thursday, March 9th, 2023, Silicon Valley Bank was still operating like any other major American bank. Its doors were open. Employees were answering emails. Startups were processing payroll. Investors were preparing for another ordinary business day. From the outside, nothing looked unusual. But beneath that calm surface, something extraordinary had already begun. Not a robbery, not a cyberattack, not a financial scam. Something far more dangerous. A collapse of confidence. By the next morning, one of America's largest banks would no longer exist as an independent institution. No armed criminals walked away with bags of cash. No vault had been blown open. No hacker emptied customer accounts. And yet, in less than 48 hours, more than $40 billion was scheduled to leave the bank as frightened customers rushed to move their money elsewhere. One of the fastest bank runs in modern financial history. What ultimately disappeared wasn't just cash. It was trust. This is the story of Silicon Valley Bank. But this isn't really a story about banking. It's a story about something far more fragile. The invisible belief that holds the entire financial system together. And what happens when that belief disappears? At the speed of a smartphone notification. Before we continue, if you enjoy uncovering the hidden forces that shape money, investing, and the economy, take a second to like this video. It genuinely helps the channel reach more people who enjoy stories like this. And if you're new to Money Elevate, subscribe and turn on notifications. Because by the end of this documentary, you'll never look at a bank the same way again. To understand how one of the biggest bank failures in American history happened, we have to go back 4 decades. Silicon Valley Bank was founded in 1983 at a time when California's technology industry looked very different from the global powerhouse we know today. Personal computers were still new. The internet didn't exist for the public. Google hadn't been created. Apple was only a young company. Most traditional banks saw technology startups as risky, unpredictable businesses with little collateral and uncertain futures. Silicon Valley Bank saw something different. Instead of avoiding startups, it built its entire business around them. It became the bank for entrepreneurs, venture capital firms, and technology founders. The place where ambitious ideas found financial backing long before they became billion-dollar companies. As Silicon Valley grew, so did the bank. Companies that would later transform the world kept their deposits there. Venture capital firms introduced new founders to the bank almost as a rite of passage. Over time, Silicon Valley Bank became deeply woven into the fabric of America's innovation economy. By the end of 2022, the bank had grown to approximately $209 billion in total assets and held more than $175 billion in customer deposits, making it the 16th largest commercial bank in the United States. It wasn't viewed as reckless. It wasn't known for exotic investments. If anything, it had a reputation for being one of the safest and most respected banks serving the technology industry. Which raises an uncomfortable question. How does a bank that looks this strong collapse almost overnight? The answer begins with a global pandemic. When COVID-19 swept across the world in 2020, governments and central banks unleashed unprecedented economic stimulus. Interest rates fell to nearly zero. Investors searched desperately for higher returns. Money flooded into venture capital at record levels. Startups raised billions of dollars. And much of that money ended up sitting inside Silicon Valley Bank. At first, this looked like the greatest opportunity in the bank's history. Customers were depositing cash faster than the bank could lend it. Billions of dollars arrived in a remarkably short period. But hidden inside that flood of money was the seed of the crisis that would eventually destroy the bank. Because every bank faces the same question. What do you do when customers deposit far more money than you can immediately lend? The answer seems simple. You invest it. And that's exactly what Silicon Valley Bank did. At first, everything looked like a dream. During 2020 and 2021, the technology industry experienced one of the greatest funding booms in its history. Interest rates were near zero. Governments had injected trillions of dollars into the global economy. Investors were desperate to earn higher returns. and venture capital firms suddenly had more money than ever before. Startups that only a few years earlier had struggled to raise funding were now closing investment round worth tens, sometimes hundreds of millions of dollars. And almost all of that money needed somewhere to live. For thousands of technology companies, that place was Silicon Valley Bank. Deposits flooded in at a breathtaking pace. By the end of 2022, customer deposits had grown to well over $170 billion, nearly tripling compared with just a few years earlier. For almost any business, that would sound like incredible news. For a bank, it created a very different problem, because banks aren't designed to let billions of dollars simply sit idle. Deposits are supposed to be put to work. Normally, banks lend that money to families buying homes, businesses expanding operations, or entrepreneurs starting companies. But Silicon Valley Bank faced an unusual challenge. Its customers weren't borrowing nearly as fast as they were depositing cash. The bank suddenly found itself sitting on tens of billions of dollars with nowhere profitable to lend them. So management made a decision that, at the time, looked both logical and conservative. Instead of chasing risky investments, they bought one of the safest financial assets in the world, U.S. Treasury bonds, along with government-backed mortgage securities. To most people, that sounds almost impossible to criticize. After all, the U.S. government has one of the strongest credit records in the world. The chances of those bonds defaulting were incredibly small. And that's exactly why Silicon Valley Bank believed it was making the responsible choice. But hidden inside those safe investments was a risk that few people outside the financial world truly understand. Interest rates. Here's a simple way to think about it. Imagine you own a bond paying 2% interest every year. A year later, new bonds start paying 5%. If someone has the choice, why would they buy your older bond paying only 2%? They wouldn't, unless you sold at a discount. That's why, when interest rates rise, the market value of older bonds falls. Not because they're unsafe, but because they're no longer attractive. This is called interest rate risk. And in 2022, that risk exploded. Facing the highest inflation America had seen in roughly 40 years, the Federal Reserve launched one of the fastest interest rate hiking campaigns in modern history. Within a single year, rates climbed from almost zero to more than 4%. For borrowers, it meant more expensive loans. For homeowners, higher mortgage payments. But for Silicon Valley Bank, it meant something far more dangerous. The billions of dollars in long-term bonds it had purchased during the era of ultra-low interest rates were suddenly worth far less than what the bank had originally paid for them. On paper, the losses were enormous. But here's the detail that changes everything. Those losses weren't necessarily fatal, because accounting doesn't always work the way people imagine. If Silicon Valley Bank could simply hold those bonds until maturity, the U.S. government would repay their full value. The paper losses would gradually disappear. The bank could survive. Time was its greatest ally. And that's why, throughout most of 2022, few people outside the banking industry believed Silicon Valley Bank was in immediate danger. The real threat wasn't hidden inside the balance sheet. It was hidden inside the behavior of its customers. Unlike most banks, Silicon Valley Bank didn't serve millions of ordinary households spread across the country. Its clients were unusually connected. Startup founders, venture capital firms, technology executives, investors who attended the same conferences, sat on the same boards, shared the same WhatsApp groups, the same Slack channels, and often took advice from the exact same handful of venture capital partners. That meant information, whether true or false, could spread through Silicon Valley faster than almost any financial institution had ever experienced. The bank had built its greatest strength around one tightly connected community. It would soon discover that the very network which fueled its extraordinary growth could also accelerate its collapse. And all it would take was one announcement. Sometimes, history doesn't collapse over decades. Sometimes, it collapses in a single email. On the morning of March 8, 2023, Silicon Valley Bank announced two pieces of news that, individually, weren't unusual. First, it had sold a large portfolio of securities at a loss of nearly $1.8 billion. Second, it planned to raise more than $2 billion in fresh capital from investors to strengthen its balance sheet. To professional bankers, this wasn't automatically a disaster. Banks raise capital all the time. They sell assets. They adjust their balance sheets. On paper, this looked like an attempt to solve a problem before it became dangerous. But financial markets don't react only to numbers. They react to what those numbers might mean. Within minutes, analysts began asking uncomfortable questions. If Silicon Valley Bank had been forced to realize such a large loss, how much larger were the unrealized losses still sitting on its balance sheet? That uncertainty spread through Silicon Valley faster than anyone imagined. Not through television, not through newspapers, but through smartphones. Venture capital firms began calling the founders they had invested in. Private Slack channels exploded with messages. WhatsApp groups filled with warnings. Text messages started arriving one after another. Some investors weren't saying, "The bank is going to fail." They were saying something much more powerful. "Move your money, just in case." And that's all fear needed. Imagine you're the CEO of a startup. Your company has $20 million sitting in one bank. Next Friday is payroll. Hundreds of employees expect to be paid. If the rumors are wrong, moving your money costs almost nothing. But if the rumors are right, your entire company could stop operating within days. What would you do? You wouldn't wait for a government statement. You wouldn't read a 200-page financial report. You'd open your banking app and transfer the money immediately. Now imagine 10,000 founders making that exact same decision at almost exactly the same moment. On March 9th, customers attempted to withdraw approximately $42 billion from Silicon Valley Bank in a single business day. To understand how extraordinary that number is, imagine nearly a quarter of the bank's total deposits trying to leave in less than 24 hours. No traditional bank was designed for that, because banks don't keep every deposited dollar sitting inside a vault. Most of that money has already been invested or lent elsewhere. That system has worked for centuries, as long as people trust it. But trust is impossible to measure. And once it's gone, mathematics takes over. By the evening of March 9th, Silicon Valley Bank reportedly expected another $100 billion in withdrawal requests to follow. At that point, the crisis was no longer about bonds, or interest rates, or accounting. It had become something much older. A classic bank run. The only difference was speed. During the Great Depression, frightened customers stood outside banks for hours, sometimes days, waiting to withdraw cash. In 2023, there were no lines, no crowds, no television cameras showing panic outside branch offices. The entire bank run happened silently. Millions of dollars moved with a fingerprint, a Face ID scan, a single tap on a smartphone. Technology hadn't changed human psychology. It had simply made it faster. The next morning, March 10th, 2023, regulators made their decision. California banking authorities closed Silicon Valley Bank. The Federal Deposit Insurance Corporation, the FDIC, immediately stepped in as receiver. Just 48 hours earlier, it had been America's 16th largest commercial bank. Now, it was the second largest bank failure in U.S. history at the time. For thousands of startup founders, the weekend that followed felt endless. Companies didn't know whether payroll would clear. Employees wondered whether their salaries would arrive. Some businesses prepared emergency plans, not because they had made reckless decisions, but because they had trusted the same institution everyone else trusted. Then came the decision that may have prevented an even bigger financial crisis. On March 12th, U.S. regulators, including the Treasury Department, the Federal Reserve, and the FDIC, announced that all depositors, even those with balances far above the normal $250,000 FDIC insurance limit, would have full access to their money. The goal wasn't to rescue shareholders. They lost their investment. It wasn't to protect management. Executives were removed. The goal was to stop fear from spreading to other regional banks before another digital bank run could begin. Because by that weekend, America wasn't just trying to save one bank. It was trying to save confidence itself. And that's where Silicon Valley Bank stopped being a story about finance and became a story about human behavior. Because the collapse wasn't caused by one bad investment, or one dishonest executive, or one unlucky decision. It happened because millions of perfectly rational decisions, made by individuals trying to protect themselves, combined into one catastrophic outcome. And that psychological phenomenon has existed for centuries, long before smartphones, long before the internet, long before Silicon Valley itself. But here's the part of the story that stayed with me the longest. Silicon Valley Bank didn't collapse because someone walked into a vault and stole billions of dollars. It collapsed because something far more valuable disappeared. Trust. And that's what makes this story so unsettling. Every morning, millions of people wake up believing their money is safe. They swipe a debit card without hesitation. They accept a paycheck through direct deposit. They transfer money with a single tap. Almost nobody stops to ask one simple question. Why does any of this work? The answer isn't cash. It isn't computers. It isn't even the bank itself. It's confidence. The belief that when you need your money tomorrow, everyone else will still believe the same thing. Economists sometimes describe banking as a system built on confidence. Without that confidence, even healthy institutions can come under extraordinary pressure. Silicon Valley Bank became one of the clearest modern examples of how quickly confidence can disappear in a world where information travels instantly. And that's where psychology enters the story. Behavioral economist Daniel Kahneman, whose work transformed our understanding of decision-making under uncertainty, showed that people generally experience the pain of losing money much more intensely than the satisfaction of gaining the same amount. It's known as loss aversion. Think back to those startup founders. Most of them weren't trying to destroy their bank. They were trying to protect their companies. If they moved their money and nothing happened, they lost almost nothing. But if they stayed and the bank failed, they risked missing payroll, damaging their businesses, and putting employees' livelihoods at risk. From an individual perspective, moving the money was the rational decision. But when thousands of people made that same rational decision at exactly the same time, the collective outcome became catastrophic. That's one of the oldest paradoxes in economics. Sometimes, what's best for one individual becomes devastating for everyone together. And that's why Silicon Valley Bank matters far beyond Silicon Valley. Because this story isn't really about one bank. It's about how modern financial systems behave under pressure. Today's money moves faster than ever before. A rumor no longer takes days to spread. It takes seconds. A bank run no longer begins with crowds standing outside a branch. It begins with a notification, a group chat, a forwarded message, a single tap on a smartphone. Technology didn't create fear. It removed the delay between fear and action. So what does this mean for the rest of us? Not that banks are unsafe. Not that every financial institution is about to collapse. That's not what this story teaches. The real lesson is much simpler. Never mistake confidence for certainty. Diversification exists for a reason. Deposit insurance exists for a reason. Risk management exists for a reason. Financial systems are strongest when trust is supported by preparation, not by assumptions. That's why businesses spread large cash balances across multiple institutions. That's why investors avoid concentrating everything in one place. And that's why understanding how money works is just as important as earning it. Because financial literacy isn't only about making money. Sometimes, it's about understanding the invisible risks before they become visible headlines. Let's go back to the question we asked at the very beginning. What was actually stolen from Silicon Valley Bank? Not gold, not cash, not even billions of dollars. What vanished was the shared belief that tomorrow would look exactly like today. And once that belief cracked, everything else followed. Silicon Valley Bank is now part of financial history, but the force that destroyed it still exists. It exists in every bank, every stock market, every currency, every financial system built on confidence. Because markets don't collapse the moment money disappears. They collapse the moment people believe it will. And perhaps that's the most important financial lesson of all. The greatest asset in any financial system isn't money, it's trust. Protect it, understand it, and never assume it can never break. If this documentary changed the way you think about money, leave a comment below with one lesson that surprised you the most. And if you know someone who believes banks are simply too big to fail, share this video with them. Because understanding how money really works is one of the best investments you'll ever make. This is Money Elevate, where we don't just explain finance. We uncover the invisible forces that shape it. I'll see you in the next one.